So should you pay your policy monthly, quarterly, semi-annually, or annually, one-time payment per year? The answer is it's completely up to you, and you can change as the years pass. However, if you fund a life insurance policy in any frequency other than annual, the company will assess a fee. They're going to charge you extra for that. So we're going to look at a specific example. Let's get right into it. We're going to keep things very simple in this video as far as the payment frequency is concerned. So we've got a policy where someone is funding the policy with a nice round number. It's 100 grand per year. And if that number seems high, you could take a zero off. If it's 10 grand per year, the same thing will apply. So before I look at the chart actually, well, let's start here. Here's our funding, annual net outlay, $100,000 per year. Now, when this illustration was prepared, it assumed these payments were made on an annual basis, and everything was made on the policy anniversary date at the beginning of each year. So what if you wanted this policy? Because this is a high cash value policy. We've got 100K going in, first year cash value, about 89% right out of the gates, breaking even between years 4 and 5. This is something that's very attractive. A lot of people we work with go forward with this type of policy. Maybe not this company, but if they're paying in 100 grand or any dollar amount, they want a high cash value policy. That's what our company does. But when someone asks, hey, I want to fund it like this, but I don't want to pay the full amount up front. Can I pay it monthly? The answer is yes. However, I want to be aware of what the fees are. So let's take a look at the fees, and you can actually see the net dollar amounts at the top of this page, but I don't want to start there. What I want to start with is the fee disclosure you will see with the life insurance company. So if you saw this under premium payment options, what would you think here? Tell you what I would think if I'm a consumer. There's no way I'm paying anything other than annual here. However, if I'm going to pay it monthly, those fees are good to be aware of, but what's more helpful is the actual dollar amount, which if we look immediately to the left of that, we see the additional charge in dollars here. So for example, if you're going to fund the full $100,000 up front, what do I see? The number of payments I make over the course of the year is 1 at the beginning of the year, and the net dollar amount is $100,000, and there's no fee for that. That's why I see 0 in additional charges. However, if I am going to break it up over 2 payments, here's why I like dollar amounts more in cases like this. The percentage over here, I see 9.6%, higher than quarterly and semi-annual. However, look at the dollar amount. 2 payments, $102,340 is what the net dollar amount comes out to, which in additional fees is $2,340, which is a lot, over $2,300 in fees for being able to break that payment up over two payments every 6 months instead of just a one-time payment. Same thing with quarterly and monthly, but what you'll see, if we look at the monthly option, or any of the options, the more I'm spreading that payment out, the higher the charge is with respect to dollars. If I look at this, how I'm paying it in installments is if I go monthly, comes out to $8,700 per month, which if you multiply that by 12, you'll get the $104,400, which comes out to a total of $4,400 in additional fees. So is it worth it? A lot of people would say no. Now I want to add a little bit more information to this illustration. Let's go back down here to the number chart under our supplemental values, and let's look at this. So toward the top, what do we see here? Annually, we see a breakdown as to where our money is going. Here's our base premium. Then we've got money going toward our lister premium, a combination of the term rider and PUAs, our Ailer premium, which is a pure PUA, and then also a standard term rider. A lot of riders attached, but we get an itemized breakdown as to where that $100,000 is going. This is one of the most important things to be aware of, or most important questions to ask when you're trying to figure out if your policy is designed right. Where is my money going? And we see a 10% base premium, which just indicates low base premium, stuffing the policy with PUAs. $100,000 total. Now, if you're going to pay it in any other frequency, let's look at monthly just in this video, because it's usually one of these two. It's rare that it's semi-annually, annually, or quarterly. We do see that on occasion, but not as much as monthly payments and annual payments. So if we look at monthly, here we go. Nets out to $104,400. So what would happen in a case like this? If you said, I want to fund the policy monthly, but I want these numbers, this cash value, this death benefit, I want the policy to function as if I am paying $100,000 per year. So you want to pay it monthly, but you want the net result to still be this $100,000. What would end up happening is you would pay the $8,700 per month. On the illustration, you would actually see it read $104,400. And these cash values, everything else to the right would be identical in terms of value. What ends up happening is your net out of pocket is higher because the extra $4,400 is going to the insurance company in the form of additional fees. Now, what some will do is if they like a company like MassMutual, because MassMutual, if I look at their LISR rider, if I look at their scheduled AILR rider, the renewable term rider, those have to be paid the same time as the base premium. You can build in a little bit of flexibility with their planned AILR, but that's got other rules that confuse a lot of people. If you want to know how that works, I would check out our All About MassMutual video where we go through the PUA riders. But getting rid of that, the other riders have to be paid the same time as the base premium. So if you say MassMutual is the company I want to go with, I like them, I'm comfortable with their product, that's the one I want, but then you've got to pay everything the same time, you've got to deal with that additional charge. So what some have done here is start out where they pay monthly and then switch it to annually later. So you can start out with a policy where you're funding it monthly or any frequency, and then just flip it to annual later throughout the year or at any point in time during the future. And you can also do the opposite. Let's say you're paying annually and then year 5, you have a change in circumstances and say, you know what, can I just flip it to monthly for a few months or for this year? The answer is yes. You will have to deal with the fee if you're ever paying it monthly, but you can switch back and forth, which is really nice. So that's a quick overview on payment frequency. Let me show you a pretty quick aha situation, or oh, this is cool, or that's good to be aware of. We like the major mutual companies, which you already know that if you've watched any of our content, I talk about them all the time. So with the major mutuals, if we look at Guardian, which if we're concerned about high fees, this is a good option to be aware of, because what I can do with them is I can pay the base premium plus the term rider annually. So let's say I have a policy like we just looked at where you want to pay $100,000 per year. You could pay the minimum only yearly, which will be about $10,000, maybe a little bit higher with the term rider, but you can commit to that. And then you've got their unscheduled PUA rider that you could just throw into the policy at your discretion, which when you're just adding money into unscheduled PUAs, there's no additional fees or anything like that. Now, what we also want to be aware of with the unscheduled PUA rider is when we actually begin to receive dividends and interest is based on the month we deposit those additional funds. So if I'm making unscheduled PUA payments 8 months into each year, I'm not making payments at the beginning of each year, which is what the illustrations display. So I will see a little bit less cash value just as a result of getting the money in later, and that's when it begins to receive dividends and interest. But it is good, something that's beneficial to be aware of. If I really don't like fees, I can avoid it that way. Or if I'm going to pay, let's say the $10K, I'm going to pay that monthly. Well, now the fee is only assessed on the $10,000, and I can still make the rest of the unscheduled PUAs at leisure if I don't want to deal with monthly fees. But it's a cool thing to be aware of, and both companies we use heavily, MassMutual and Guardian, being two of the major mutuals that also provide a lot of flexibility. So I hope you enjoyed this video. If you did, please hit the like button, subscribe for more. If you have questions, please leave them below. And as always, I hope this helps. Thanks so much. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.